Okay, now this is dealt with quite extensively in the market profiling course. So for those of you that have done the course, apologies. This is a good refresher for you. For those that you haven't, this will give you a good understanding ultimately of how how a rules-based approach to trading it occurs effectively. And in essence, when it comes to gaps, there's a couple of questions we want to ask ourselves. So a gap is just simply where we closed up here the previous day. This was maybe the low of the previous day, and all of a sudden the market opens up a gap down, so range gap down. Now, in essence, we've seen in the ES both on Thursday, Thursday the 7th of March, as well as again on Monday the 11th. So within a space of 3 sessions, we've seen a gap down, and then obviously today or yesterday we've seen a gap up. Now the rules are simple, right? It's a bit of a binary. The first question you have to ask yourself is, does the gap fill? If it does, okay, so in other words, if we do come all the way back up, fill the range gap, right? If it does, then in essence we ask ourselves the next question. Okay, and the next question is, do we manage to sustain price inside the previous day's range? If it does, we ask ourselves the next question. Do we re-enter the value area of the previous day? If it does, then we ask ourselves the next question, which is etc, etc, etc. So there's a series of questions we ask ourselves, and this is how we develop the strategy to trading gaps. Now, the converse, if the gap doesn't fill, okay, what do we do? What's the next question? Right? The next question is, do we see initiative taken when the gap doesn't fill? In other words, do we see an attempt at the gap being filled, at which case initiative steps in and the market then navigates without filling the gap? Okay, so it's binary. It's one or the other. Either one occurs and market moves higher and we fill in the gap and continue higher, or the market doesn't fill the gap and we continue in the direction of the gap. Now, in both examples of the E-mini S&P, we've seen this instance. The market's tested the gap, failed, and all of a sudden initiative's been taken, and that's what I'm going to show you in the next example. So if I can just get a chart up, what we're looking at is the E-mini 500. So here's the first example. This is Thursday last week, and we can see obviously that's the low of the day. We can see this is obviously 5-minute candlesticks for all of you, but in essence we can see that the market opens pretty much almost goes up 3 ticks. Okay, market goes up 3 prices, and all of a sudden the initiative steps in. Initiative, we can see that the volume, okay, substantially higher than the average, but also we can see price direction. All right, so initiative's taken for almost 25-30 minutes. Market sells off from 27.70 all the way down to 27.50. Now, this is very, very typical pattern you'll see when a gap is failed to fill. Right. Now, again, one of the key lessons I think I really drove home in both the footprint course as well as the market profiling course is that you don't have to learn the strategy. You don't even have to execute the strategy. What you do have to do is note when there is a gap in the market, if it does fail to fill, do not sit on the other side providing liquidity. Okay, it's a low probability strategy that in the long run is always going to cost you money. Right? Trading is not always about knowing what to do, it's about knowing what to avoid doing. And this is one of those instances when there's a gap that fails to fill. If you don't feel comfortable because maybe the market's gapped too low or it's done something crazy, if you do see that initiative start, don't be on the other side. It's not worth it. Okay? Like I said, if we had come back and got back above that 27.75 gap, started to trade a little bit bid up and sustained a price close inside of the previous day's range, then by all means we can start to buy it. But whilst the gap impulse is there, whilst the sentiment gap is there, we do not take the other side of the trade. We either go with the flow or we stay the heck out. Okay, second example. Today's one. Monday's one on the 11th, okay? We can see again, notice that was the high of the previous session, and all of a sudden, market gaps up and pretty much goes down 2 ticks, and initiative's taken straight away. So we see a big surge in volume, and again, we see that price directional move, okay? So again, same example, same gap, market fails to fill, goes back bid, and we start to rotate higher. Now, a lot of you are going, yeah, so what, do you just buy the open and assume? No, it's not as simple as that, right? What we're looking for is firstly some form of confirmation that the gap's not going to fill. Right? The moment we have enough information that gives us an understanding that the gap is unlikely to fill, we're then looking to be long the market with a stop below. Okay, it's as simple as that, and this is what's wonderful about this trade strategy is it almost gives you maximum risk reward in the sense that we're not looking to necessarily, take this entire move, but we know where the risk is. It's exact risk. We're sitting on that gap. The moment we trade through that, low made at the open of the cash session, right? That's where we stopped out, right? So in essence, we're risking, call it 3-4 handles for potential, whatever you want to call it, 10, 12, 15 handles, whatever you would look at in terms of a target. Okay, so have a look at that strategy. Very, very neat. We've seen that twice now in the last 3 sessions, and obviously there's been some good opportunities to trade.